According to my count, we have 22 out of 22 in the classroom. Everybody must be really excited today for things going on. I will try not to disappoint everyone, okay? So obviously we've got the exam coming up on Wednesday. So you all want to know all things that are going to be on the exam. So I'm going to do my best to try to help you out with that. You know, I could probably do a little bit better job. I could just give you the exam and tell you what's on it, but that would not be fun. That would not be an effective audit of your knowledge. All right, so to start with, same rules as last time. I recommend that you show up with a pencil and eraser because it's much easier to edit your answers if you do that. You can do it in pen, but it's a little bit of a more risky proposition. You might want to bring a calculator. I'm not 100% certain that if there is math, it's going to be like the math that was on the practical exam. It's pretty easy math that you won't necessarily need a calculator for, but you know, bring one just so you have it just in case. Breakdown of questions. There are 12 multiple choice questions. There will be one question on the professional judgment framework. There will be 3 questions from chapter 6, 2 questions from chapter 7. 1 question from chapters 8 and 9 combined. 2 questions from chapter 17. 2 questions from chapter 18. And 1 question from chapter 21. By my math, that's 12. 3 points each. As far as the problems go, there are 2 problems. They're with 12 points each. The first problem comes from chapter 6 and 7. It's going to cover controls. There may be some ancillary topics related to controls taught discussion in there, like I may ask some questions related to how to sampling relate to controls, which would be chapter 8 and 9. But primarily, if you focus on chapter 6 and 7 for that, you should be fine. The other problem you already know about, because I said it's 100% chance of it. This is going to be a spot the errors question on the audit report. So I will give you an audit report with 5 errors, and you'll have to spot which errors exist. It'd be very similar to the ones on the practice exam. All right. Let's get into the nitty-gritty about what's on the exam. So first of all, this first page, every single thing on this first page, you should make sure you're familiar with, you have good knowledge of. This is the stuff that we're going to be using moving forward. So really important stuff for the exam 1. It does not go away. If you've forgotten about this stuff on exam 1, time to refresh your memory, because you're going to need to know this, not just for this exam, but for the next exam. And just as a spoiler, this exact same page is on the front of the study guide for exam number 3 as well. So like I said, the stuff doesn't go away. In fact, I give you 2 pages of stuff that you have to know from the exams, one from exam 1, and then the next second page says stuff from exam 2. So yeah, we've got a lot of stuff that we still need to remember moving forward. Let's talk about stuff that's going to be relevant to this upcoming exam. So on the professional judgment framework, I'm just going to give you one thing and one thing alone you need to know. That's the 4 common judgment tendencies. Make sure you read through those and understand the difference. That is where the question will come from. I can say that with 100% certainty. So make sure you're familiar with the differences between the common judgment tendencies. Something that I tell students to do, and it's had mixed success. Don't just go back to that discussion that we did. In fact, I think that we didn't even have a classroom discussion on this. I think I had you all watch the recording on this. You can watch the recording. I would strongly recommend that you also go and read the section of the book that talks about this, because that's an easy way to clarify the difference between these 4 judgment tendencies. So please make sure you review that. All right, chapter number 6, where the fun starts. All right, so probably goes without saying that you guys need to not only know this diagram right here, but learn how to appreciate this, because this is a foundation diagram that we're moving forward. So again, controls rely on the fact that we have risks that are present in an organization. We characterize risks using management assertions. Our controls should address the risk in the management assertion, and the test of controls should address the implemented control that's in place. So make sure you know this diagram right here. This will save you a lot of headache. We will be looking back at this diagram pretty heavily for the business process sections of this course, which are going to be the stuff for chapter 3, or for exam 3, okay? So make sure you know this diagram and know it well. All right, in the study guide, said there are 3 objectives of the COSO integrated framework: reporting, operations, and compliance to laws and regulations. So make sure you know those three catchwords: reporting, operations, and compliance. Those are really important. And then I ask you a very important question: which is generally the most relevant to a financial statement audit? Which of the three objectives is the most important? Reliability of financial reporting, because keep in mind that whereas auditors were trying to make sure the financial reports or financial statements are free from material misstatement. So our focus is going to be very heavily on those, the controls in that area. So it's really, really important to note that. Does it go without saying that I probably am going to ask questions on components of internal controls? So everybody remember that I asked this on the exam in AIS and said, this is on the exam in AIS. Make sure you know this. By the way, for those of you who didn't take the final exam, it was also on the final exam in AIS, okay? I ask it a whole bunch of times. I ask it a lot of times. So make sure you know this stuff really, really well. I always ask questions on this, and make sure you're familiar with all these. This is not, we really didn't add anything onto this from what I taught you all in AIS, but again, I still think it's really important to know all the difference between all these, not just the sequence and what their names are, but what they represent. Also, something that is relevant to audit that I do talk about occasionally, when we talk about the design of internal controls, generally that's going to be associated with control activities, okay? When I talk about the operating effectiveness of internal controls, generally that's going to be focused on information and communication, the monitoring of controls. So remember, we talked about the way two ways controls can fail: deficiency in design and deficiency in operating effectiveness. Generally, we're talking about design, we're talking about whether the controls have been put in place. So we're talking about this area right here. When we talk about whether controls are operating effectively, there's a lack of information and communication or a lack of monitoring of controls. Those are the ways that controls can fail in operation. So something to note. Substantive strategy. Substantive strategy basically says that we're not going to rely on controls. We're instead going to rely on substantive test of detail to gain all of our assurance in a process area. So that would also say that there's probably a difference between a substantive strategy and a reliance strategy. Make sure you understand the difference between a substantive strategy and a reliance strategy. That definition should become clear. I believe it starts on when an auditor should use a substantive strategy. That's in the chapter 6 slides on slide 13. So make sure you're familiar with that. But it probably also goes say, I don't think I actually stated outright what a reliance strategy is, but I would recommend that you're familiar with both of those, the reliance strategy and substantive strategy, and how they differ. 3 limitations of these internal controls. This is one of my favorite things to talk about. So remember, controls are great. Controls are not perfect. They can't solve every single problem. So these are 3 limitations that even a good system of internal controls cannot effectively address. So we have management override, errors and mistakes, and collusion. All 3 of those are scenarios that controls may not be effective in answering. All right. I know I've said this before, and I know I'm going to say it again, not just in this class, but in every class I ever teach in the future, but I'm going to repeat it for you one more time. The types of audit evidence gathered for controls testing. There are 5 of these. Make sure you know the 5 of these that are listed here, all 5 of them. Not just the names of them, but what they all represent and how they're used in controls testing, okay? Do not forget them. Do not add things in there, okay? Do not add different tests that are in there. Like, for example, if I say, how do we use analytical procedures in controls testing? What's your response be? Should we don't use analytical procedures in controls testing because it's not one of these 5 items, okay? So these are the 5 types of tests that we can perform as test of controls. So make sure you're familiar with all of those. All right, chapter 7. How do we evaluate control deficiencies? Well, keep in mind that they start out as control deficiencies and they become more significant depending on the magnitude. So we first of all have to assess likelihood. If something is at least reasonably likely, then we assess the impact, okay? That's where we assess magnitude. If it's significant but not material, that's where we call it a significant deficiency. If it's material in nature, that's where we call it a material weakness, all right? Steps in reporting ICOFR. I'm just going to tell you right now, this, to say it right here, this takes up like a quarter of the page. And historically speaking, students have been really, really dicey on studying this stuff. So this is actually chapter 7, slides 8 through 11. We spent a good 15 minutes talking about this content. And there will absolutely be a question on it on the exam. So please make sure you study this, okay? Make sure you have some familiarity with this. One of the most important things you'll note, this is all important, okay? I'm not saying that you shouldn't ignore it, but one of the most important things is going to be about evaluating identified control deficiencies, okay? So what do we do when we identify a control deficiency? That's where we go back and say, okay, how big is it? Okay, and what is going to be the response to that? We're going to get that into just a moment. But again, all of this stuff under steps in performing an integrated audit, or steps in reporting audit by ICOFR. We had several slides in that, slides 8 through 11. Make sure you spend some time focusing on that and learning those steps, okay? Probably also just as something, a weakness that I've noticed. I talked about 4 different entity level controls in our lecture. You might want to go back and refresh your memory on that. For some reason, when I say entity level control, all thought and all matter goes away, and people just like entity level control. That's a control over the entity, and I'm like, yes, that's right. What's an example of one? Okay, and there's a lot of them. Okay, so please make sure you spend some time on that. All right. What happens if management fails to provide a representation of a coffer? I'm not likely to ask a question on this, but I don't think I talked about this specifically I don't think I talked about this specifically with respect to the slides. That's a scope limitation because we actually cannot do our job if management does not provide a written representation. All right, something that I will very likely ask questions on, if not multiple questions, is section right here, okay? What is the difference between control deficiencies, significant deficiencies, and material weaknesses? So at the very base level, you should know the difference between those 3 concepts. You should understand what constitutes a control deficiency, what constitutes a significant deficiency, what constitutes a material weakness. Additionally, associated with that, you should know what type of audit opinion is issued for each type of deficiency. So let's just talk about that real quick. If I have a control deficiency or if I only have control deficiencies, what type of opinion do I issue? Unqualified, okay? If I only have significant deficiencies, what type of opinion do I issue? Unqualified. If I have material weakness, any material weakness, what do I issue? Adverse. Now keep in mind, this is the audit. This is audit of internal controls over financial reporting. This is a separate report from the ones that we talked about in chapter 18. Okay. We didn't look at examples of those report, but this is a separate audit. This is part of the integrated audit. So we don't have qualified opinions there. We can have a scope limitation, but that would be separate from these. Okay. That would basically saying we could not do our job. That could result in an adverse opinion. But generally speaking, we're going to be limited to unqualified opinion or an adverse opinion. Also, who does audit report to regarding to each of these types of deficiencies? So let's list them out. Let's say that I'm an auditor and I identified only control deficiencies in my audit. Who am I going to tell? Management, okay? Let's say that I have some significant deficiencies. I'm going to tell management. Anybody else? The audit committee, good, okay. Then I have material weakness, okay? I'm going to tell management, the audit committee. Anybody else? Everyone else, okay? It gets reported externally on the audit report. That's one of the things that gets reported on the audit report is a material weakness. That's where we have an adverse opinion. All right. Sampling discussion. I wanted to do some clarification here because I look at this and I really need to update this and I've done a very bad job of this, okay? So first of all, where it says tolerable error, make a note here that I'm referring to the tolerable deviation rate. It's actually the same exact thing. I just used terminology different from what I used in the slides. Same for expected error. This is the expected population deviation rate. I apologize for the lack of consistency. I'm old, I'm inconsistent, okay? Also, something that I did not list up here, but was actually in the practice exam and maybe on the exam itself, you do need to know how to calculate the computed upper deviation rate. Computed upper deviation rate. And what is the significance of the computed upper deviation rate? Remember, that is the number that we compare to the tolerable deviation rate to determine if the control is effective, okay? If we have a computed upper deviation rate that's greater than our tolerable deviation rate, we say the control is not effective. If we have a computed upper deviation rate that's lower than our tolerable deviation rate, so we say the control is effective. We're going to look at an example of that in the practice exam, but that's important to note. I just forgot to mention that, which is, given the size of the study guide, it's amazing I forgot to mention anything, okay? Also, when we talk about attribute sampling, what phase of the audit is it almost exclusively used? So remember, attribute sampling is answering a yes or no question. Variable sampling is trying to extrapolate a dollar value. So when I'm talking about attribute sampling, I'm looking to answer a yes or no question, such as, is the control effective? So that would mean that it's going to be test of controls, okay? Test of controls is almost exclusively where we use attribute sampling. All right, contingent liabilities, fun contingent liabilities. So we don't really have too much there. Make sure you know the rules on contingent liabilities. They have to be for accrual. They have to be probable and reasonably estimable. For disclosure, they just have to be reasonably possible. For remote, that's where we don't have to do anything. So I know that's GAAP, I know that's financial accounting, but it's something that comes up quite frequently in audit. All right, type 1 versus type 2 events. These are very important, okay? So what are these? What is the difference between these? Type 1 event, the conditions existed at the balance sheet date and were resolved before the issuance of the financial statements, okay? Type 2 event, the conditions did not exist at the balance sheet date, but is significant enough that shareholders will want to know about it. An example of each. A lawsuit is a good example of a type 1 or type 1 subsequent event. A natural disaster is an example of a type 2 subsequent event. What are our treatments for each of these types? Okay, what is our treatment for each type of subsequent event? The type 1 event, we basically go back and restate the financials because we know what the outcome of the issue is going to be, and the conditions exist at the balance sheet date, so we go back and make a restatement, or at least we tell the client that they have to go back and restate the financials. Type 2 event, there's two possibilities, okay? First of these will always occur. It's going to be a disclosure of the event, okay? Disclosure of the type 2 event. What is the second one? Pro forma financial statements could possibly be issued there. Those are forward-looking financial statements disclosing what the impact of the uncertainty is. Those are not always used, but they could be if it's severe enough. Good. All right. What is dual dating and how does it limit an auditor's liability? So remember, dual dating is basically saying when you have a subsequent event, we as auditors have a responsibility for that. If the event occurs after the audit report date, but before the issuance of the financial statements, we can dual date our auditor's reports, which basically says we are responsible for everything up to the auditor's report date and the singular event that occurred after the audit report date. That limits the liability. What is the other option? The other option is extending the audit report date to the date that the date of the subsequent event acknowledgement. I want to say subsequent event, the date of subsequent event. That's not exactly correct. Technically speaking, it would be extending the audit report date till the date of the end of testing of the subsequent event. If we extend the audit report date, that basically means that we're taking liability or taking responsibility for everything that occurred up until that date. So it's extending liability as opposed to limiting liability. Okay, let's talk about subsequent discovery of facts existing at the auditor's report date. So what does that mean? Keep in mind, for this to occur, this has to be something that occurs after the issuance of the financial statements and after the issuance of the audit report that has a material impact on the financial statements. So the example, remember this is where I was saying you were sitting on the beach somewhere and you're sipping your pina colada and the client contacts you and says, yeah, something that was relevant to the financial statements that you should have known about, I didn't tell you about, you need to know about this. So what do we do as auditors in that situation? We go and we fix the problem. That's basically all there is to it. But you'll notice there's a number 3 by there, which that 3 is probably relevant, don't you think? What does that 3 mean? That 3 means what happens if we tell the client we're going to come fix the problem and they say we'd rather that you not. That's the point where we say, look, if we can't fix the problem, you can't use our audit report. We're going to tell every regulatory agency that we know about the problem, and we're going to tell everybody who's relying on the financial statements about the problem. So 1, 2, 3. We're gonna restrict you from using the audit report. We're going to tell the regulators, and we're going to tell everybody who relies on the financial statements. That's what those 3 items mean. 8 elements of standard unqualified audit report, PCOB. I'm going to tell you that this is the minimum that you should know for the report. And what did I say when I was going over this in class? I said, if you know those 8 elements, you probably can do about 6 points out of 12 on that problem on the exam, okay? My expectation about your knowledge of this is going to be much more in depth than just knowing the 8 elements. My expectation is that you have a really good understanding of the standard unqualified reports. You don't have to memorize it word for word, but you do need to know it very well, what the contents are, what the sections are. I'm going to go into a little bit more detail and depth on that here in just a second. So I guess it's actually, yeah, you should know all the critical elements, standards on qualified reports as a certainty that I'll ask you to spot the errors on the report on the exam. You will, again, identify half of these pretty easily if you just know those 8 errors. If you find the 6 points out of 12, that's cool, okay? If you really want to do well in the exam and get this section down, you need to go look at that standard unqualified reports, know the sections, know the wording that's pretty consistently used in the content of the sections. I use the word boilerplate, and then I said, what does boilerplate mean? That means that it uses the exact same wording over and over again, so that the wording is very consistent. You'll use throughout the standard unqualified report. But make sure you know what all the elements are. Make sure you know what the language is used in each of the sections of each of those elements so you can identify those. And then once you've done that, when we talk about other versions of audit reports, you can actually say, this is what's different from the standard unqualified report. And you can look for those differences. If you remember, the differences were pretty easy for the qualified opinions. Qualified due to departure from GAAP only had 2 changes. Qualified due to scope limitation had 3 changes. Adverse opinion only had 3 changes. And then scope limitation, disclaimer opinion had about infinite changes. Okay. It was like 10 changes. Okay. But they're pretty consistent to understand if you understand the nature of the scope limit or the adverse opinion. Sorry. Disclaimer opinion. I'm really all over the place today, guys. Sorry. Okay. So again, right here, make sure you know this stuff right here. Make sure you know the 8 elements. Make sure you know what's contained within those 8 elements pretty quick, consistently. Circumstances required modified wording. There is only one scenario that comes up, and that is where the auditor does not want to take responsibility for the work of another auditor. So you're the primary auditor, you're doing the work, somebody else is doing other parts of the work, and you say, they're doing a fine job, but I'm not going to take responsibility. In that situation, that's the only situation where modified wording comes up, but it requires a change to the opinion paragraph, the basis for opinion section. And then it also requires an addition of an explanatory paragraph. So it's important to note because that's the only scenario for that. Okay. I think I've skipped something. I am so sorry, guys. I skipped something back in chapter 17. I saw a note on it. It's like this. All right. So what does going concern mean? Is going concern a good thing or a bad thing? Going concern is a good thing. Substantial doubt about the entity's ability to continue as a going concern is a very bad thing. Okay. So if we say Dr. Barnes is a going concern, is that a good thing? Let's hope so. We want Dr. Barnes to be a going concern for a very long time. If you're in that camp, it's like, I really wish Dr. Barnes is no longer a going concern. That just makes me sad. Okay. So we want Dr. Barnes to be a going concern. A going concern is a good thing. Substantial doubt about the entity's ability to continue as a going concern. That's a bad thing. What happens if we as auditors are going to be, if we find out that there's substantial doubt about our client's ability to continue as a going concern? Is that a concern, cause for consternation? Cause for problems? Yes. That basically means that they may not be in business a year from now. We have to do 3 things. First of all, we got to go talk to the management and say, what are your plans to fix this problem? All right. So first of all, first thing is say, does substantial doubt about the entity's ability to continue as a going concern exist? That's number 1. Number 2, go talk to management and say, what are your plans to fix this problem? Management says, we've got great plans. They're the best plans ever. And we think so as auditors that they will fix the problem. We stop there. But what happens if substantial doubt still exists? That's where we have to actually have management disclose this in the financial statements. And we have to change our audit reports to add an explanatory paragraph to mention this issue, this going concern issue, that we have substantial doubt about their ability to continue as a going concern. I want to keep in mind, I'm going to mention this again when we get to it. Going concern issue itself does not change the opinion being rendered. But if management fails to disclose that they have a going concern issue, that would be a problem. That's a departure from GAAP, and we would have to issue a qualified or an adverse opinion due to departure from GAAP. So the failure to disclose the going concern issue would be problematic, not just the going concern issue by itself. Does everybody understand the distinction between that? It's a little bit dubious, okay? If they say, all right, we acknowledge that we have a going concern issue, let's put that in the financial statements, you can still issue an unqualified opinion in that scenario. But if they say, look, we know we have a going concern issue, but we don't want people to know about it, that's where we as auditors would step in and said, yeah, you're violating the rules, adverse opinion. Okay. So keep that in mind. There's a difference between those two. All right. Circumstances that require an explanatory paragraph. There are 4 general situations. Okay. Make sure you can identify and explain the examples of each. They're pretty straightforward. The report on ICOFR, going concern issue, anything that affects comparability, and then anything that requires additional emphasis. That's basically it. Conditions for the departure from an unqualified report. This is where we have something that's different from our unqualified opinion. And what are the reasons for that? This is really important because you have to understand what are the opinions that are being rendered. We actually had a homework assignment where we talked about all the different types of ways that opinions can be issued. So when we have a qualified opinion, that can arise from a departure from GAAP that is material, but not pervasive, or a scope limitation that is material, but not pervasive. So material departure from GAAP, material scope limitation. A disclaimer opinion arises when there's a pervasive scope limitation. A pervasive scope limitation. By the way, what does scope limitation mean? I use that term, I bandied it about a few times already. What does it mean? Yeah, auditors not able to do their job. Okay, they tried to do something, they were not able to do it, so they can't answer the question, is everything okay? There's also a number 2 there. So there's another condition which we might have a disclaimer opinion. It does not exist in PCAOB reports, but it may exist in ASB reports. What is that other condition? Auditor issues a disclaimer of opinion when they are not independent from the client. When they are not independent from the client. We had an example of that in the homework. Remember, we had a guy who was the stakeholder in the organization. He had a whole bunch of the stock and he was not independent. And he tried to do the audit. We said, nope, disclaimer opinion. Not likely to come up, but still important to note. Adverse opinion, that's a pervasive departure from GAAP. Major violation of the rules. I want to make sure you note this real quick. The foundation for understanding the audit report problem is making sure you understand the standard unqualified report. It is likely that I will ask you for an opinion type or to review an opinion type other than the standard unqualified report. So you need to actually, once you've got this unqualified opinion type down, make sure you understand the differences for the qualified, the disclaimer, and the adverse opinions. Review the different examples on it says Blackboard. Wow, I haven't updated. Brightspace, okay? I thought I'd updated all instances of Brightspace in this course. Who knew? So yeah, this is supposed to be Brightspace. As a reminder, the report opinion types, they're all 5 listed there, okay? Not just the standard unqualified report, but all 5 of those. So you can actually see what the differences are in the report types, if you're curious about that. All right, chapter 21, the only thing I'm going to tell you about chapter 21, there's 2 items that you should focus on. So the star and italicized here, knowing what the level of assurance, attestation, risk, and type of report and report distribution is for each type of engagement. Okay. And related to that, make sure you know the list of attest services. They're not hard to remember. They're pretty straightforward, but that's going to be the first one, is making sure you know that the 2 tables that are related to this attest services. And the other one related to assurance services, for each category of assurance services, be able to identify whether independence is required, whether a report is required, and what type of assurance is provided. There is one multiple choice question on this chapter. I did not put a lot of emphasis on it. It's going to come from one of those 2 areas. Okay. Any questions on the study guide? All right, then let's get to the exam. Auditors may be prone to rely on evidence that is consistent with their pre-existing beliefs and expectations. This is a judgment tendency. It's also considered to be a bias, a very, very well-known bias. Which one is it? It's confirmation tendency. That's where we think we only rely on evidence that confirms things that we already know. So confirmation tendency or confirmation bias. According to section 404 of the Sarbanes-Oxley Act of 2002, what is an auditor's primary responsibility with its clients of internal control, clients internal controls? Is it responsible for the design and maintenance of internal controls? No, who's that responsibility? Management. Is it responsible for the implementation of internal controls? No, in fact, those exact words are used in the SOX 404. Management's responsible for the design, implementation, and maintenance of internal controls. So I basically just kind of split those apart. Is it responsible for understanding and assessment of internal controls? Yes. Assessment of internal controls is sporadic, depends on whether or not we choose to rely on internal controls. Understanding of internal controls is required in every single scenario, every single situation. Even if we choose not to test internal controls in an area, an auditor has to understand internal controls. So C is our answer. Assessing control risk at a lower level than high most likely would involve what? Changing the timing of substantive procedures by performing most substantive procedures testing at interim. Is that correct? No, that has nothing to do with that. Okay, the changing the timing would actually provide less assurance here, where we'd need to have more assurance in testing substantive procedures. Identifying specific internal controls relevant to specific assertions. So if we're going to test controls, then we probably need to follow the control sequence, right? What is one of the steps in the control sequence? Making sure the controls are relevant to assertions. Is that something we talked about? Yes, it certainly is. So B is our answer. But let's go through the rest. Performing less extensive substantive procedures with smaller sample sizes than the original plan. If we're going to be assessing control risk at a lower level than high, then we probably would have less extensive procedures because we have a lower level. But again, that is not something we determined beforehand. We would determine afterwards, after we've actually tested controls. So this is not proper sequence because we're still in testing controls phase. Reducing inherent risk for most of the assertions were relevant to the significant account balances. So can we as auditors control or affect inherent risk? No, we can assess inherent risk, but we have no control over what it is. That's a function of the client's entity and its environment. So we can't do anything about D. All right. Which of the following is a reason why testing of specific control might take place in interim? Okay. What do you guys think? What would be the primary reason we want to do stuff at interim as opposed to doing it year end? So because maybe we're a little bit less busy at interim than we are during year end? Yep, that's our answer. External auditors are generally busier at year end than at interim. Casey Staden, what a name. Casey Staden, CPA, is conducting an audit of internal controls over financial reporting. I offer in unison with annual financial statement of Isaac Eisen Industries Incorporated, which I'm going to call 4i from now on. Which of the following would not be one of the steps that Casey would follow in identifying which test controls to test for audit of 4i? So keep in mind here, this is asking, she is trying to determine what steps she's going to follow in order to test controls. She needs to actually planning for her testing of ICOFR, okay? 3 of these are actually listed as things that you do as part of the plan. In fact, do you remember that segment in chapter 7? I said people tend to not spend enough time focusing on this. Those 3 items are listed in the study guide that it would be doing. So which of those 3 items, which of the 3 items are listed? Identifying any level controls, identifying significant accounts, and understanding likely sources of misstatement. Let's just say that you did not remember that, and you said, okay, I'm not 100% certain. She says, A says, forming an opinion on the effectiveness of 4i's ICOFR, okay? Would you form an opinion as part of identifying which controls to test? Or would you form an opinion after the controls that you're going to test have already been tested? Yeah. So this is not going to be a planning step. This is something that occurs after we've already identified the controls to test. So A is our answer. Casey Staden is a concluded audit over 4i's ICOFR. The only one noteworthy item came to Casey's attention during the audit. She concluded this item constituted a significant deficiency based on Casey's conclusions to which party should she report her findings. So who do we talk to when we have a significant deficiency? Do we talk to management? Yes. Do we talk to the audit committee? Yes. Do we disclose it externally? No, we do not. Just to management and the audit committee. B is our answer. As part of her testing of internal controls over financial reporting, Casey Staden employs selected attribute sampling techniques. Which of the following adjustments to Casey's input would most likely result in Casey having to increase the size of her sample, assuming all of their inputs remain the same? I have no idea why there's a parentheses closed right there. That's weird. Okay. All right. Would a population affect sample size? No, population generally doesn't affect sample size unless it's a significant amount. Okay, by a significant amount. Larger sampling risk. So larger sampling risk would mean what for confidence level? A larger or smaller confidence level? So remember, sampling risk is basically like if sampling risk is 5%, confidence level is 95%. It's 1 minus 100% or 100% minus whatever the number is. So sampling risk is 5%, confidence level is going to be 95%. So if I make my sampling risk larger, confidence level will be smaller, okay? Confidence level is smaller, then it means my sample is going to be smaller, okay? Smaller expected population deviation rate. Again, it's assuming all their inputs remain the same. So if I make my expected population deviation rate smaller, it's going to make the gap between tolerable deviation rate and expected population deviation rate larger. What does that mean about sample size? Sample size gets smaller, okay? The distance between those two is inversely related to a sample size. What if smaller tolerable deviation rates? So tolerable deviation rates up here, expected population deviation rates down here, okay? I make tolerable deviation rate smaller, the distance becomes less, okay? There's a smaller distance, which means our sample is going to get larger. D is our answer. D is our answer. In addition to her role as a top-notch auditor for 4i, Casey Staden also provides attestation services for a client. On a recent client engagement, Casey made the following statement in her attestation report. We are not aware of any material modifications that should be made. Based on the above language, what type of attestation engagement did Casey perform? This is an interesting question. What type of language is being conveyed in this particular statement? So specifically, what type of assurance is being conveyed in this type of statement? It's negative assurance. This is a negative assurance statement. There's only one type of engagement that uses negative assurance. Which one is that? A review. A review uses a negative assurance. Casey Staten is concluding her testing for the financial statement audit of 4i. As part of her testing, Casey must perform procedures designed to identify potential contingent liabilities that are not properly accrued or disclosed. Which of the following procedures below would be the least useful for this task? Okay. So this should be a gimme if you have paid attention to what I was saying. So she's trying to identify potential contingent liabilities. Could she inspect documentation related to 4i's guarantee arrangements? Yes, that's one of the things we talked about in class. Okay. Could she review minutes of the board of directors meetings? That's another possibility that was listed in the slides. Could she send confirmations to financial institutions that 4i does business with? Seems reasonable, saying, okay, this is a possibility that you've got a guarantee arrangement associated with here. It might get contingent liability. This is a possibility. What about issuing a letter of audit inquiry, which we also call a legal letter, to 4i's attorney? Would that be a method of identifying contingent liabilities? That's the last one for a reason. It's probably a no. Why is that a no? Why is B our answer? Because the lawyers suck, okay? The lawyers suck. They're not going to tell us any information they want to know. Can you hear me, Professor Templeton? Yeah, I said that. Anyway, all right. So yeah, all right. I don't know if he's got a class right now. So all right. No, so remember what we thought about the lawyers. The lawyers are they're representatives of the clients. If the client isn't going to tell us any information, the lawyer's not going to volunteer additional information. If we already have the information about contingent liabilities, the lawyers will share that information. They will corroborate that information for us. But as far as identification of any contingent liabilities, we cannot rely on the lawyers. Therefore, B is our answer. Because we cannot identify, we can only use it to corroborate. All right, prior to the issuance of Casey Staten's audit report, 4i settles an outstanding lawsuit for the amount different from the recorded contingent liability audit financial statements. What step should Casey insist that 4i take with respect to the settlement? So a contingent liability related to a lawsuit, type 1 or type 2, guys? Type 1, it's a type 1 subsequent event. We only have one type of criteria for a type 1 subsequent event. What do? We force them to adjust the financial statements to reflect the settlement of the lawsuit. Type 1s always result in adjustments to the financial statements. All right. As part of auditing procedures for its foreign subsidiaries, 4i has engaged a secondary auditor to perform the necessary testing. Casey Staten has reviewed the work of the secondary auditor and is satisfied with the quality of the work. However, she is unwilling to take responsibility for the work of the secondary auditor. Assuming that Casey issues an unqualified report on the 4i's financial statements, what changes would be necessary for Casey to include in this report? Should she add an additional explanatory paragraph below the opinion paragraph? Yes. Okay. Should she modify the wording in the basis for opinion section? Yes. Should she modify the wording in the opinion section? Yes. What does that leave? All of the above. One of those 4 times that all of the above is a correct answer, but you didn't need to know all 3 were correct answers, or you just needed to guess D and say, "Hope you got correct." I hope this is one of the 4 times that Dr. Barnes used all of the above as the correct answer. If you did it, you got it correct. Congratulations. This question will not be on the exam. All right. With respect to 4i audit, Casey is also responsible for reading certain information to ensure that it's consistent with information presented in 4i's annual financial statements. Which of the following will be an example of this type of information? We talked about this as a specific example in class. What did I show you and say this is an example of this type of information? Remember, it's a picture of the Big Mac and McDonald's logo, and I said, I've never seen a Big Mac look that good. What was that? That was the annual report. That was the annual report. The client can actually put whatever they want in the annual report, but if they use financial information that is from the financial statements, it has to be consistent with the audited financial statements. We as auditors do not have a responsibility to corroborate or audit that information, but we have to read it to make sure it's consistent with the financial statements. All right. Let's move on to the this section, the problems. By the way, the practice exam key should be available to you now if you are curious. All right, internal controls are quite simply the greatest thing ever. That's an actual quote that I said, believe it or not. One critical area of accounting is internal controls. So let's ask some questions about internal controls. Okay, we discussed something called the control sequence. Recreate the diagram that you use to create the control sequence. Now I'm going to assume that your diagram is not nearly as cool as my diagram right here, because again, that's a work of art. Mine is a work of art. Okay. But if you had something that looked like this, then you got that correct. What does it mean? It's basically that every organization is subject to certain inherent risks. If we identify the risks, we as auditors characterize these risks as management assertions. We want to make sure we have controls that address these risks / assertions, and we want to make sure that we implement tests of controls to test these controls, okay? So this is a client responsibility, this is an auditor responsibility, but they all relate to one another, okay? COSO integrated framework identifies 3 objectives. Which of these 3 objectives is most relevant to a financial statement audit? And briefly explain why this objective is the most relevant. We already identified that in the study guide, but that was reporting, okay? This is due to auditor's responsibility to ensure the financial statements, the ultimate product of financial reporting, are free from material misstatements. All right, what did I say one of my favorite things is? The 3 inherent limitations of internal controls. Management override, okay? Management can open that cash register even there's not a transaction. It's necessary to be able to do because sometimes the person at Taco Bell doesn't give you your change for your Mexican pizza that you paid for, okay? So you have to have management override. Then you've got errors or mistakes. Errors or mistakes can happen and we can't control those. So they may actually result in bypassing of our internal controls despite our best efforts. And then collusion. That's where we say segregation of duties is present, but what if 2 people have responsibility in different areas collude to bypass those controls? Is it possible? Certainly is, and it happens all the time. All right. Oh, this is a fun one. Assuming you've been assigned to perform sample testing of client's controls, here's the inputs are provided based on the information above to state whether each control is operating effectively or not operating effectively. By the way, this is an actual exam that I used in the past. My students were not happy with this question. It was only 3 points out of 60, but they still were not happy with this question. This actually reflects on a homework assignment that we did in chapters 8 and 9, okay? So remember in that question, it was a multiple choice question. You had to calculate the sample deviation rate and add the allowance for sampling risk. So let's go ahead and do that. Number of deviations of the sample is 3, the sample size is 100. That means our sample deviation rate is... Not everybody at once. 3%, 3%, 3 divided by 100 is 3%. We add our allowance for sampling risk. What does that give us? That gives us the computed upper deviation rate, okay? So 3% plus 4.5% is 7.5%. Our tolerable deviation rate is 8%. 8% is greater than 7.5%. Therefore, the control itself, control number 1 is effective. We do the same procedure for control number 2. We take 6%. Now we get 6%, which is going to be greater or less than 4%. Sorry, I got those sides. I got this. Oh, sorry. Okay, I'm confused. Why 6% is less than 4%? 6% is less than 8% because 8%. The control number 2, 4 deviations out of 100. 4% plus 4% is 8%. 6% is less than 8%, which is 4 plus 4. So that control is not effective because our computed upper deviation rate is greater than our tolerable deviation rate. Same thing or same idea behind here. We say our tolerable deviation rate is 9%. Sample deviation rate is 6 divided by 200, which is 3% plus 4.2 is 7.2%. 9% is greater than 7.2%. It's effective. So yeah, question on sampling, pretty basic one though. Let's get at it in this one. Okay. Due to problems encountered in the audit, the Adams and Adams issued a disclaimer opinion on its audit report. Okay, so we're going to have to identify what's going on here. So there's some issues in this report. Some of these are pretty easy. Some of these are a little bit more challenging. Okay, so let's go ahead and let's see figure out. So let's start out with the section at the start up here. Okay, so we've got our report title, we've got our addressee, we've got our statement on this disclaimer opinion of the financial statements. Everything seems to be starting out well. Is there anything that we need to look at in the opinion paragraph that might be problematic? So what was the number 1 rule when we talked about a disclaimer opinion, the changes in language that are required in disclaimer opinion? If it talks about the work the auditor performed, there needs to be some sort of change to say that they did not perform that work, okay? So like in the very first paragraph, the very first words say, we have audited. If we disclaimed an opinion, did we audit? No, we tried to, but we could not do that job. So remember, the language has to be changed to say, we were engaged to audit. So the first error is going to be that very first sentence in the opinion paragraph, we were engaged to audit. All right. Next, you will notice that we've got the basis for a disclaimer opinion, okay? And we go immediately from our opinion paragraph, which looks like opinion paragraph basically said, they were unable to satisfy ourselves as inventory of the cost of property equipment, not appeal to the sufficient of property audits, and we do not express an opinion on the financial statements. And then go immediately to the basis for opinion paragraph, disclaimer opinion. Is everybody cool with that? Moving from this paragraph right to this paragraph right here. Obviously, there's something missing. What's missing here? So it talks about the nature of this, the basis for the disclaimer opinion. But didn't we recall something when we looked at these examples? Whenever there's something that's not an unqualified opinion, there has to be one or two paragraphs immediately following the opinion paragraph that explain what is the nature of this issue. Okay, what is the nature? So there needs to be more detail as to what is the issue with the inventory quantities and the property equipment that we cannot satisfy her with. Like, what did we try to do? What we're unable to do? What were the dates? What were the areas in the financial statements? What's the financial impact? There should be a big long paragraph right here that says, "Hey, here's the issue. We don't know what's going on. We cannot audit. Explain it in detail." By the way, this first error is worth 2 points. This error of the missing paragraph, that's worth 3 points. It's a critical one. All right. Moving down to the basis for disclaimer of opinion. Okay, so remember, basis for opinion, this is the basis for opinion section. This is going to be starting out our management responsibility, then finishes with audit responsibility, and then we have our scope paragraph. Okay. So is there anything wrong in the basis for opinion section or the basis for disclaimer opinion section? Okay, are there more than one thing wrong in the basis for opinion section? Still yes. Okay, so we have two things wrong in the basis for opinion section. Okay, one of these should be glaringly obvious. What is the reason for a scope limit? What is the reason for a disclaimer opinion? What do we call that? Pervasive scope limitation? Okay. What is this paragraph called right here? This is our scope paragraph. Okay. If we had a pervasive scope limitation, could we do any of this work? No. What happens to the scope paragraph in a disclaimer of opinion? Gets cut. Okay. Gets completely removed. So this paragraph should be gone. Okay. That one's the easy one. What's the hard one? Okay, what's the hard one? Let's look up here. We got our management's responsibility, financial statements, responsibility, company's management. Everybody good with management's responsibility? Okay. Our responsibility is to express an opinion on the company's financial statements based on our audits. Okay. So everybody good with that statement right there? What's the problem with that statement? What does disclaimer of opinion mean? Disclaimer of opinion literally means we did not issue an opinion. What does this statement say right here? Our responsibility is to issue an opinion. Okay. Does anybody see some inconsistency in that? If we're not disclaiming issue an opinion, we can't say our responsibility is to issue an opinion. So what happens here? This gets cut. I'm going to put strike through to it just for context. Okay. So yeah, this gets cut also right here. Hold on. There we go. Strike through there. Just so we're seeing, we have audited, that has to be changed. And there's a missing paragraph right here. So that's 4. That's 4. Got one more. Anything else that we're missing here? The audit report date. Audit report date is missing. That was low hanging fruit though. That was an easy one. Should have picked up on that one. All right. So opinion paragraph needs to be modified to say we were engaged to audit. Explanation of opinion needs to be provided. We did not have a paragraph explaining the opinion, which is required for all non-unqualified opinions. We have to have that explanation of the change in opinion. The responsibility section for the auditor's responsibility, that first sentence needs to be eliminated because we did not issue an opinion. Scope paragraph completely gone because disclaimer opinion, and we have to have audit report date. How'd you guys do? 12 out of 12? I saw a lot of shaking heads when I was going through that right there. So if you were struggling on this one, you might want to spend some time focus on this because this is about the quality level that you're going to have for the exam to get ready for. All right. See you all on Wednesday.